forecast. With the forecast, the value of the company is theoretically the value of the future cash flow. So now that we've estimated what the future cash flow is, we want to see what that's worth compared to its current price. Because the market has valued the company today based on what the market sees as the today's value of this future cash flow. Okay, so we want to do this independently, this valuation, and when we do it, we use an approach called the discounted cash flow model. Now I'm just going to tighten this up so you can see a little better, or I can see better. Okay, so in the case of BAU, we have, what we're doing is essentially taking EBIT less taxes, which is on our unlevered net income, adding back depreciation, and taking out capital expenditures. So essentially, I'm calling this an unlevered free cash flow. So this is the cash flow that the company is spitting out today. That's my forecast. Am I right? Am I wrong? I don't know. But we have it. So then we're going to say, what is that worth today? And there's two ways when we do a discounted cash flow. We could go through and build this, but for purpose of this, you just need to know there's a discounted cash flow model. This is how it works. Here's the assumptions. The first one is values the company, assuming that after a 5-year period, we sell it as a multiple of its earnings. So that's the first one we call the exit multiple model. And you make and only the light blue here, this is all you have to do, is what am I going to sell my investment for after the 5 years? So I made an assumption, 8, 10, 12. You can make your own assumption. Okay. I also said you got to discount it by something. Now, we calculated out in the previous assignment what the weighted average cost of capital was for the company. You could use that. But investors are always going to be looking for a better return than just a risk-free. So in this case, I use 10, 12 and a half, and 15 is the discount rate. And then I've multiplied, these are the multipliers that I think I'm going to sell. So I put in my debt, because the value of the company's got to service the debt, and the number of shares. So you can read through all these calculations, and if I've made a mistake, do let me know. Will, you going to do that? You're going to find my error in this?
I'll try.
Yeah. But when you put in your assumption of what you're going to sell it for and your discount rates, it's going to come back and tell you that under different scenarios, the value of the company today, if you believe, let's just say, if you believe my BAU, you believe I'm accurate here or reasonable, the value of the stock is between $49 and $68 a share. That's the present discounted cash flow of the company based on its debt and the assumptions that I made relative to revenue, given I'm going to exit the company after 5 years. Okay. Second one methodology is that we're not going to sell it at the end of 5 years and that it's going to last in perpetuity. Now I'm going to hold it. So I then have to make an assumption of what is the growth rate going to be. Okay. And that's past the 5 years. So going on, I put in 1%, 2%, 4%. Okay. So it calculates it out once again, and I'm making between 66, it's worth between 66 and 96. Okay. This one was 49 to 68. So I'm getting a range, okay, under different methods. Okay. And you can play with this and say, well, what if the growth rate into perpetuity is 6%? Well, it's worth a lot more. But we know that the GDP hasn't grown over a long-term period at 6% that I recall ever. We're probably closer to 3. Okay. So you start to play around with these, and you've now done a discounted cash flow. It's not a hard thing when you understand the concept. So the concept is you're going to sell it at the end. So what is that present value of this cash flow, or lately this cash flow? What's the present value of that? And what's the value when we go to sell it at the end of the term? Okay. Do the same thing for bull, same thing for bear, but we're basing it on a different set of cash flows. Okay. So once you do that, everybody okay with that? You got to jump in if you're not, because I'm going fast. Next one is multiples. This is just a different method. What I did is their PE today is 7. Okay. I went through the peer group, and US Steel had a loss, so there was 0, but the simple peer average was 558. So I said, okay, if they're selling at 719, if they were in the peer grouping and their PE was 558, then the stock would be around 1695. Then I said, okay, let's assume it will continue to price or be valued at 7, what it is today. And I changed here, I changed the earnings per share, which came right from my forecast. So in 20, holding the PE at 719 and my calculated earnings per share, which came right from forecast BAU, right here. Okay, that came over here, and it would say the stock is worth 24.57, and applying the same methodology, it gave me a forecasted price range from 20 to 24. I did the same for the bear and the bull. Now, here's another one we throw in as we're evaluating. It's the enterprise value multiple. And that's a market cap plus of the stock, which is the share price times number of shares. If they have preferred stock outstanding, plus debt, less cash, gives us an enterprise value right here. Then we take the enterprise value divided by EBITDA, which we've calculated. Okay. And right now, their enterprise value is at 4.58. When I look at the sector, it's 7.58. When I did my simple average, it's 614. So my conclusion is, based on the enterprise value multiple, Steel Dynamics is undervalued compared to the sector and to its peer group. Okay. So that's the computation. So now we look at, well, how do we pull this together and come up with something? And this is a summary for business as usual. And the terminal value I took from here. So I literally took this box here, pulled them together and said, okay, under these scenarios, this is the range. So when I averaged them out, the two methodologies, the value of the company is somewhere between $45 and $59 a share. Okay, that's the range. That's a big range. But when we look at it in relative terms, I'm probably, if going back to that statistical forecast, I'm probably, given a pure mathematical situation, I'm pretty accurate. I'm going to be pretty accurate. Okay, now, but it's only as good as my assumptions. If I do the peer group, I would say the value is between 32.8 and 42 versus 45 to, they're all variables. So that's where we're coming down. We now have all of the data we need to move forward. Questions? Jerry.
I'm almost confused. I'm gonna have to rewatch the video, I think, a couple times.
Okay, what made you help me?
I don't know. I got lost somewhere in the beginning.
Okay.
Yeah, I'm just being honest.
Oh, no, I want you to be honest. Okay. Where did you get, oh, somebody else, let's go around. Hannah, where are you? Did you get lost too?
It was just a lot to take in.
Okay.
So I'll probably just have to watch the video a couple times just to really get it.
Okay. Kelly.
Yeah, I agree. It was a lot, but I just feel like once I go through the Excel and look at the references, it will all make more sense.
Okay. Holton, now you've done some discounted cash flows, right?
Yeah, the CFA challenge has prepared me well for this. So
Okay, so did you get a haircut or did you cut your own hair?
my dad cut it, and I will both cut now. Yeah, it's unfortunate, but you gotta do what you do sometimes.
Okay. Okay. May, how are you doing with this?
I missed the first few minutes because
Okay.
I couldn't get into the room.
Ah,
I
okay.
think I'll probably have to rewatch everything and go over stats and quant.
Okay. You'll also find that there are other videos under the forecast around that to give you more depth. This was just intended to give you another shot to go through it. Again, you might find everybody's busy. And some are, we're trying to stay busy. You probably can do this. I encourage you to do this sooner than later. I redid it yesterday from my worksheet, and it took me 4 hours to redo it, just to put you in a context. So the question is, in the next 3 to 4 days, do you have 4 hours?